Britain and Germany sign a comprehensive treaty aiming to deepen ties in defence, transport and migration. The Federal Reserve reports that economic activity is picking up, but the outlook remains pessimistic. And Israel announces a 42 billion shekel increase in defence spending for 25 and 2026. Good evening and welcome to the Qnews Economic Bulletin. I'm Mark Summers. We start with the latest news where Britain and Germany have signed a comprehensive friendship treaty during Chancellor Friedrich Merz's inaugural London visit, aiming to reset UK-EU relations. The agreement deepens ties across defence, transport and migration. Under the new treaty, both nations will jointly promote exports of co-produced military equipment, like the Typhoon Eurofighter and Boxer armoured vehicle. Further solidifying defence cooperation, German tech firm Stark will establish its first AI-powered unmanned systems factory outside Germany in Britain. Beyond defence, the treaty includes plans for a new direct rail link between the two countries and joint efforts to combat irregular migration. In a joint press conference, British Prime Minister Sir Keir Starmer and German Chancellor Friedrich Merz underscored significant economic benefits from their newly signed friendship treaty. Prime Minister Starmer announced that the historic pact is expected to create 500,000 British jobs and significantly strengthen defence industries for both nations and NATO. Chancellor Merz, speaking alongside Starmer, noted that both Germany and the UK are actively revising their economic policies to navigate complex global challenges. He highlighted the importance of leveraging the British-German partnership effectively to foster mutual prosperity. Meanwhile, in Germany, the central bank, the Bundesbank, has reported that the country's economy lost momentum again in the second quarter. It also warned that the imposition of US tariffs would have a further dampening effect on the economy and that GDP may stagnate in the second quarter. The Bundesbank noted that demand for German industrial products, both domestically and internationally, remained weak despite recent upticks. While business confidence edged higher in June, Germany's export sector now faces mounting headwinds from US tariff policies in the short term. Back in the UK, the Office for National Statistics reported that British pay growth slowed in May and employee numbers fell last month. However, the cooling labour market was less severe than previously indicated, easing some policymaker concerns. Annual wage growth, excluding bonuses, slowed to its lowest since the second quarter of 2022 in the 3 months to May at 5%. The number of employees on company payrolls dropped by a provisional 41,000 in June after a 25,000 decline in May. Data showed that this measure of pay growth slowed to 4.9% in the 3 months to May. It added that the number of job vacancies fell by 56,000 in the second quarter to 727,000, the lowest number since the 3 months to April in 2021. Moving to Asia now, and Vice Minister of the Ministry of Agriculture and Rural Affairs, Mehrdan Mugati, has said that China's agriculture and rural economy maintained stable growth in the first half of this year. With a bumper harvest of summer grain, the steady income increase for farmers, and a stable situation in rural areas. The National Bureau of Statistics showed that the country's super grain output reached 149.74 billion kilograms. Megati stated that the fixed asset investment in the primary industry saw a 6.5% rise from the previous year, and rural retail sales climbed 4.9%, totaling 3.24 trillion yuan. Japan's finance ministry has revealed that exports fell for a second straight month as sweeping US tariffs took a toll on the country's manufacturers, with its fragile economy exposed to greater risks from the global trade war in coming months. Exports from China dropped by 0.5% in June year-on-year in value terms, and exports to China were down 4.7%. Meanwhile, exports to the United States tumbled 11.4%, dragged down by a 26.7% plunge in automobiles and a 15.5% fall in auto components, and a 40.9% plunge in pharmaceuticals. Japan's trade surplus with the US in June fell 22.9% to 669 billion yen. However, total imports grew 0.2% in June from a year earlier. As a result, the trade balance stood at a surplus of 153.1 billion yen. To Africa, and South Africa has urged G20 nations to offer global cooperative leadership to address rising trade barriers and other complex challenges. Speaking after President Donald Trump's tariff threats, South African Finance Minister Enoch Godongwana emphasized the need for the G20 to provide strategic global leadership, cooperation and action.
We meet at a time of a fragile global economic growth, while inflation is gradually moderating and financial conditions have started to stabilize in some regions. Uncertainty continues to weigh heavily on global growth prospects. Rising trade barriers, persistent global imbalances, and new geopolitical risks are significant concerns. In the face of these complex challenges, the G20 must remain a source of strategic global leadership, cooperation, and action. We must extend our efforts if we are to reach our true potential as a collective, to enable us to deal decisively with economic, environmental, developmental, and social challenges that plague especially Africa, low-income countries in other regions, and small developing states.
South Africa's seasonally adjusted retail sales increased 0.1% month-on-month in May. It noted that seasonally adjusted retail sales increased and that the latest figures indicate continued growth in South Africa's retail sector, though at a slower pace compared to the previous month. Now to Oceania, to Australia. The Australian Bureau of Statistics has revealed employment growth was modest in June, with the jobless rate rising to its highest level since late 2021. This signals a potential weakening of the previously robust labour market, strengthening the case for an interest rate cut next month. Data showed that net employment rose in Australia 2,000 in June from May, while the jobless rate popped up to 4.3% from 4.1%, the highest since November 2021. It added that full-time jobs dropped 38,200 in June, while hours worked fell back 0.9% after a sharp rise in May. The participation rate ticked up to 67.1%. To the United States, and the Federal Reserve has reported that economic activity picked up in recent weeks, but the outlook was still neutral to slightly pessimistic, as businesses reported that higher import tariffs were putting upward pressure on prices. It added that the loss of immigrant labor is adding to their struggles with the effect of fast-changing trade policies as the Trump administration's economic strategies began gaining traction. The Fed reported also noting that contacts in a wide range of industries expected cost pressures to remain elevated in the coming months, increasing the likelihood that consumer prices will start to rise more rapidly by late summer. The Commerce Department's Census Bureau has revealed that United States retail sales rebounded more than expected in June, but some of the increase likely reflected higher prices for some goods exposed to tariffs. Retail sales increased 0.6% last month after an unrevised 0.9% drop in May. Retail sales, excluding automobiles, gasoline, building materials, and food services, increased 0.5% last month. The Labour Department's Bureau of Statistics has revealed that import prices rebounded marginally in June amid cheaper energy products, but higher costs for consumer goods were consistent with a tariff-driven increase in inflation. Import prices increased 0.1% last month after a downwardly revised 0.4% decline in May. In the 12 months through June, import prices fell 0.2%, matching May's decrease. Imported fuel prices fell 0.7% in June after dropping 5% in May, and food prices declined 0.8% after easing 0.7% in the prior month. Prices for imported consumer goods, excluding motor vehicles, jumped 0.4% last month after dropping 0.3% in May. Imported capital goods prices were unchanged, while those for motor vehicles, parts, and engines slipped 0.1%. The Labour Department has revealed that the number of Americans filing new applications for jobless benefits fell last week, pointing to steady job growth in July. Though some laid-off workers are experiencing long spells of unemployment because of a moderation in hiring. Initial claims for state unemployment benefits dropped 7,000 to a seasonally adjusted 221,000. The number of people receiving benefits rose by 2,000 to 1.956 million in the week ending July 5th. The unemployment rate 44.1% in June from 4.2% for 3 months, largely due to people leaving the labour force. The Federal Reserve has reported that United States factory production edged up in June as a decline in motor vehicle output was offset by gains elsewhere, though manufacturing remains constrained by tariffs on imports. Manufacturing output ticked up 0.1% last month after an upwardly revised 0.3% increase in May. Production at factories increased 0.8% on a year-on-year basis in June, as it grew at a 2.1% annualized rate in the second quarter after expanding at 3.7% in the January to March quarter. Overall, industrial production increased 0.3% after being unchanged for 2 straight months. Industrial output advanced 0.7% on year basis. It increased 1.1% rate in the second quarter, slowing from the 4.3% pace notched up in the first quarter. Now to the Middle East and North Africa. Egyptian President Abdel Fattah el-Sisi has issued presidential decree approving a financial agreement related to the Green Facility Programme between the EU and the Arab Republic of Egypt. The agreement includes a grant of €7 million, according to a statement by Egypt's official gazette. This decision follows the joint launch by the Egyptian government and the EU delegation in Egypt of the European Fund for Sustainable Development Plus mechanism, which provides €1.8 billion in investment guarantees. The Jordanian-Syrian Economic and Trade Committee has convened in Amman to discuss deepening bilateral cooperation and enhancing economic integration across key sectors. The Jordanian Minister Yarob Kuda and Syrian Minister Mohammed Shah co-chaired a meeting to strengthen economic relations between their nations. Their discussion focused on boosting cooperation in crucial areas like transportation, agriculture, customs, and industrial and free economic zones. The ministers underlined the importance of removing barriers to trade exchange and achieving tangible progress in projects. Discussions between Jordan and Syria also focused on expediting the registration of Jordanian pharmaceuticals in Syria. Central Bureau of Statistics has reported that Israeli inflation in June accelerated, led by increases in the cost of foreign travel, food and fresh vegetables, as well as housing prices. Annual inflation over the past 12 months increased to 3.3%, up from 3.1% in May. On a monthly basis, the Consumer Price Index, the CPI, rose in June by 0.3%. Foreign travel costs edged up 4.5%, and hotel stays rose 8.1% as dozens of airlines cancelled services to Israel amid the war with Iran. Israel's finance and defense ministries have announced raising defense spending by 42 billion shekels in 2025 and 2026, citing the country's security challenges. In a statement, they highlighted the budget agreement will allow the defense ministry to advance urgent and essential procurement deals critical to national security, they say. Finance Minister Bezalel Smotrich stated the new defense budget fully funds the Gaza conflict and comprehensive security preparations for threats from the south, north and other regions. Israel's Ports and Shipping Authority has stated that the Eilat port will suspend all operations as of June 20th due to an escalating debt crisis that has paralyzed the strategic facility. The National Emergency Authority disclosed that the Port of Eilat's operations ceased after the Eilat municipality froze its bank accounts over unpaid local taxes, rendering continued function impossible. It also warned that the closure could halt logistical support for the Israeli Navy in the region. Now joining us from Paris is the former World Bank advisor and now director of the EU Asian Centre, Meher Nicolas Fursley. Thank you very much for being here with us on Q News. So how might this sustained inflation in Israel above the government's target affect household purchasing power and the living standards in Israel? If you could give us an idea of what you think.
It's a very complicated issue, so it's a matter of the glass half full, right? So I'm not here to defend the Israeli government, far from it, but I think so far, considering all the pressures that the Israeli economic machinery had to withstand in the past 2 years, is doing quite well. So not amazing, but is doing quite well. It is true that inflation is above target. And it's true that as a consequence, both households, consumers and private sector companies, which rely on borrowing when the interest rate is high and inflation is above target, it's not great for them, but it's nothing dramatic. So it's nothing dramatic. Here, the main metric is GDP growth. All of Israel's enemies were looking at a collapse of the GDP growth because of the long sustained war. I mean, the problem is that, Israel's army is not a professional army in the sort of French, British sense. It's more of a Swiss type army, which relies a lot on the conscription, on the constant conscription of civilians. And when they are conscribed into the army as the war drags on, they leave the factory, they leave the office, and it's bad for GDP growth, right? Because it's not a professional army, it's a citizen army. That's the way the country is. So to make a long story short, the biggest thing we have to look at now is GDP growth. According to the latest estimates, growth came down from 3% or 3.2%, which was expected a year or a year and a half ago, to 2% or 1.9% today, right? That's the annualized expected growth for this year. Now you could say, oh my God, it went from 3.2% to 1.8, 1.9. Oh my God, it's a 50% decline, right? That's the glass half empty. But the glass half full is, considering the war, etc., it's not bad. Let's look at, countries like Israel, like France, for example, or most Western European countries. Today, they're growing at 0.5, 0.6% per annum. So at 2%, in terms of real GDP growth, Israel is doing quite well.
Okay.
Another metric which I think is interesting, of course, because of government deficit, there's a sizable 6-7% budget deficit, which is bad. It's really non-sustainable. It's a direct consequence of military spending. Okay, it's bad. But if you look at the flip side of the coin, the consequence of that Israeli government budget deficit, what is it? It's borrowing. So Israel has to borrow more money. It's not good. But let's look at the debt, the government debt to GDP ratio. It went from 60% before the start of the war to 67, 68% now. So it's bad. Yes, it's not great. But right now, countries like Italy, France, or even the US, they have a debt to GDP ratio of 110 or 120%. So here again, Israel is not stellar or amazing, but it's doing quite well. So to make a long story short, what I'm coming at is the situation is not bad. Not bad. You mentioned Eilat. You mentioned Eilat earlier. That's a symbolic blow to the Israeli economy. Eilat, to be honest, is not a rich city. It's the third largest Israeli port, far behind Haifa and Ashdod. So
but it still might have quite an effect on supply chains, though, would you say, and increased costs for businesses and perhaps consumers?
Yes, I mean, I think, Eilat roughly it's 15 or whatever, 14% of the Israeli supply chain coming from seabound containers, right? So if you take the whole Israeli supply chain, including, roads and airports, Eilat's influence or size falls down to 7 or 8%. It's not great. It's not good, clearly, but it's not horrible, because all the action now is around Haifa and Ashdod. And what's interesting, in that new American-Chinese Cold War, which is now the main sort of geo-economic issue of our time, what's interesting is in Haifa, for example, the biggest port, you have Chinese and Indian private and government-controlled companies rushing to expand the Haifa port, spending, billions of dollars in Israel, and the money is coming from India and China. That's interesting because it's a vote of confidence in Israel. And one last thing I want to mention, I'm aware of time. To me personally, what's interesting is now NVIDIA, right? So in the past 12 months, literally in the past year, NVIDIA went from being the world's 15th or 20th largest company to now being the world's biggest company. So it's amazing what happened to the market cap of NVIDIA in the past 11, 12 months. And of course, behind it, you have the AI tech revolution. So NVIDIA, an American, Taiwanese, American company, let's say from California or Oregon, is now the world's biggest capitalist industrial player by a big margin.
Okay.
And what's interesting is...
Go on. No, go ahead then. Go ahead.
is NVIDIA announced recently at the beginning of the year, they were expanding their presence in Israel. And last week, they announced again that they were like quadrupling or quintupling the size of their presence in Israel. And they're going to build in the coming quarters in the north of Israel, in Galilee, a multi-trillion-dollar AI, R&D, and production, microchip production facility. That's also an amazing vote of confidence considering the war.
Yes, well, you were saying that obviously Israel is not doing too badly, and certainly not running out of money to keep sending missiles into its neighbors, whether it be Syria, Lebanon, Iran, or of course what's happening in Gaza. But will defense spending eventually have an effect and affect Israel's fiscal balance or the amount of money that it could spend on public sector resources?
So here the answer is probably yes, if the war drags much longer. And here the problem, once again, is not spending, because Israel, having a relatively low national, debt, government debt to GDP ratio, Israel can afford a very long war by borrowing more, and they can even afford to have an abnormally high budget deficit, right? They can bite the bullet. The problem here is conscription, because once again, like Switzerland or Singapore, it's a citizens' army. So by removing away from the workforce engineers, technicians, CEOs, CFOs, traders, you name it, in the long run, it's not good for the economy. And in the long run, it could destabilize the Israeli economy by removing too many people away from the private sector workforce. So I think that is the issue I am concerned about. And I think that's why there is pressure now on Netanyahu's government, even from the so-called right-wing capitalist Likud backers, even from the people who like him. There is pressure on him to wrap up and close the war.
So basically, the business sector have their workforce taken away as conscripts for the army,
Yes.
And they're going to start putting pressure on the government to get this war over, so they can have their staff back. Is that basically what do you think?
Absolutely right, and that's the price to pay when you are, by design, a citizens' army, which was how Israel was built since inception, since 1948, just like the Swiss and the Singaporeans. If you have a British or French model where it's a professional army and you go to war, you don't have that kind of problem.
Well, thank you very much indeed for joining us. Always a pleasure, Nick. Thank you very much, Meher Nicolas Fursley, who is the director of the EU Asian Centre. Thank you for joining us from Paris. Have a good day.
Pleasure.
Now we move on to the latest developments in the commodities sector. Oil prices rose even as global trade tensions appeared to cool, with analysts pointing to low inventories and renewed Middle East risks as factors supporting the market. Brent crude futures were up around 0.5% to 68.83 a barrel. US West Texas Intermediate crude futures were up 0.9% at $66.99. Gold prices extended declines and fell nearly 1% on Thursday after upbeat U.S. economic data aided the Federal Reserve's cautious stance on resuming monetary easing this year. Spot gold fell 0.9% to $3,315.15 an ounce after hitting a session low of $3,309.59. U.S. gold futures fell 1.2% to $3,320.80 an ounce. Global markets showed a collective gain during trading sessions, with European indexes and U.S. futures posting modest gains, while Asian markets were mostly up. In the United States, S&P 500 futures were up 0.38%, NASDAQ futures jumped 0.71%, and the Dow Jones Industrial Average futures inched up 0.27%. In Europe, the UK's FTSE 100 gained 0.53%, Germany's DAX 1.36%, and France's CAC Coron hiked 1.18%. To Asia, and Japan's Nikkei 225 increased 0.60%, and the Shanghai Composite edged up 0.37%, while the Hong Kong Hang Seng Index fell 0.08%. Just before we go, let's just recap the main economic headlines today. Britain and Germany sign a comprehensive treaty aiming to deepen ties in defence, transport and migration. The US Federal Reserve reports that economic activity is picking up, but the outlook remains pessimistic. And Israel announces 42 billion shekel increase in defence spending for 2025 and 2026. Well, that's all for now. Thank you for joining us tonight. Don't forget you can follow Q News for more 24 hours a day at Q News EGY. Thank you for watching. Enjoy the rest of your Thursday.